Hey, welcome to my live stream. It is a Sunday evening. It is April 27th, and I'm getting ready to start the week here and see where the market's going to take us this week. We have had a really nice week this past week where we had real positive momentum in stocks. We had Tuesday, Wednesday, Thursday, Friday rally, and a it was a nice week. It was a breath of fresh air. We've been on a 2-month, bear market, and we may be beginning something here. If we can, I guess, if there are no new stories around tariffs and no new big concerning stories, we may we may either go sideways or maybe just have some modest losses or some modest gains. I think it's going to be dictated by earnings. We have huge earnings coming up this week. I was taking a look at the economic data that's out there. We do have some jobs data that's going to come through. We're going to hear how the economy is growing on Wednesday with the GDP report. The consensus is that we're going to go down to 0.4. Now, if this came in negative, would the market sell off? Maybe, maybe not, because a lot of investors feel that a recession's already priced in, but we'll see where the data shows. And it'll just, if anything, if we see a slowing economy, it may really compel the Federal Reserve to act and begin to lower short-term interest rates. So that certainly can happen. Then we have jobless claims. That information is going to be released. But what is going to move the market are earnings. Earnings are going to be what move the market. And I wanted to do kind of a preview of what's coming. Let me say hello to the people that are signing on. Android PC, how are you, sir? And I usually don't stream on Sunday nights, but had to tend to some family, and I'm really glad I did so. And I wanted just to stream. I'm kind of getting my plan in order for the week. Let me know what topics you think would be interesting to talk about. Love to hear that. As I go through, if you're a paid member and you want to look at a stock, I would love to dig into a stock. Would love to analyze it. Go through an intrinsic valuation of that stock, and please put that in the chat. If you're not a member and you'd like that, $5, and I will do a deep dive. If you're not a member of my channel, I'd love for you to be a member. It doesn't cost a whole lot, and you get a lot of perks. Please consider being a member. The details are on the description of this video. Looks like Jay Zev is in. Anthony, how are you, sir? I view Amazon. So here's a comment from Anthony. And thanks so much for being a new member. I appreciate it very much. I view Amazon's earning as litmus test for the consumer sentiment. I agree. Amazon's CEO just sold 5,000 shares. Yeah, I agree with you that Amazon tells us a lot about the economy, because a lot of people buy on Amazon to save a few bucks. My wife does a great job on Amazon. When we need stuff, she finds really good deals, and she always, kind of buys ahead of birthdays and holidays and so forth. So if we see that Amazon comments that, hey, people are pulling back, that is a pullback from like a demographic that is substantial. That would be middle America. Just about everybody buys on Amazon. And, I'm sure people buy luxury goods on Amazon. But I think Amazon just sells just across the board everything. So it would be a really interesting earnings. So I'm an Amazon shareholder, and I will certainly be tuning in. I will review Amazon when it gets announced. We'll take a closer look. And looks like, yeah, I'm glad you're here too. Thanks for tuning in. And let me know if you want me to analyze Amazon. Since you brought it up, I'll put it on the list. We'll take a look at Amazon. We'll look at the fundamentals. and see what's happening with Amazon. So looks like people are joining in. Thanks so much. What I'll do is let's just kind of go through the days that are coming. We're going to close out April, and it's been a wild ride, man. Last 2 months have been a wild ride for the U.S. markets, and we kind of deserve that a little bit. If we look at the last 5 year, we were just riding in high stock price heaven. Up 91% over 2 years, just gliding along, and boy, that was nice. So then the market said, wait, so market's too expensive, so it sold off. So okay, we took some medicine. Did the medicine work? Are we going to stop with the symptoms of being overpriced? Potentially. We shall see. So when we look at the year to date, we had a pretty rough, couple months. All right. Took our medicine. Now, since that low point, hey, look at that. We're up 13.85 on the NASDAQ. I really liked from the low point last week to the end of the week, up 9.5%. Wow, that is nice. 4 days, 9.5% rally. Sign me up. I would love for that to happen again this week. Now, that would be stupendous, but if we can get through the week with we're up 1%, 2%, that'd be fabulous. That would be really, really great, because it would make, I think, the month of April a positive month. And maybe that's the beginning of something. That certainly would be great if it happened, but we'll see. We'll see. It's going to depend on earnings. As we look at the earnings that are coming up, Monday is, I think news can move the market on Monday. We have some interesting earnings that are coming up, but they're not like consequential. They're just, good companies. Welltower, Waste Management, right? Garbage pickup and waste management. You have NXT Semiconductors. This is the Fomento Económico Mexicano. This is like the bottler of Coca-Cola and other beverages down in Mexico. You have Nucor, a steel producer that's going to be announcing. Domino's Pizza. We got F5, which is in like networking, network technologies and so forth. So that will be interesting. But they're not huge caps. Tuesday, now we're getting to some bigger names. Visa, Visa, along with like Amazon, as Anthony stated, Visa also tells us about the consumer. If Visa sees volumes pretty much increasing, it's very bullish for the economy. Hey, the economy is doing well. People are using their Visa cards to buy stuff, services, experiences. So that would be kind of a real good data point for the economy. On the flip side, if Visa reports that, hey, we had a bad Q1 because spending was down, that could be bad news. Coca-Cola is stable, steady Eddie, not expecting much there. AstraZeneca, I think these guys have been selling off. Be interesting to see where that's at. It's going to be a big healthcare day on Tuesday because Novartis is also going to announce. I know their stocks have been really down. HSBC Bank, bookings will tell us about travel. So that's discretionary income. I'm expecting they're going to put some cautious guidance out there. The airlines have been saying, hey, we are seeing a pullback on travel. So we'll see what Booking has to say and if they are in line with what banks are saying. A stock that I've got my eyeballs, pretty much focused on is Pfizer. Pfizer's been growing for 2 consecutive quarters. If they grow this third consecutive quarter, I'm expecting a rally in Pfizer because I think the market will realize, hey, these guys are growing at 25%. This is a big revenue company that's really been sold off. So really looking forward to that one. Spotify, that's a big cap stock, leader in streaming of music. American Tower, that's a real estate investment trust, really focused on, the towers that enable us to use our mobile phones. Altria for cigarettes, Starbucks, just a lot of earnings. We've got 168 earnings on Tuesday. Even UPS is going to be out there. So a lot going on Tuesday. Wednesday's huge. Microsoft, huge. Meta, right? On the same day. And this both after the market closes. And Microsoft has a flourishing business, but their stock has been really performing poorly for a year. They've been selling off this year. And I think the capital spent in the data center has been a concern to investors. We'll see what they have to announce. Google announced this past week, and they announced with very positive earnings, and their stock did rally on. They announced on Thursday after the market closed. Google stock rallied on Friday, and it also helped Meta, by the way. So that's going to be a big market mover is Microsoft. Meta right behind it. I'm expecting they're going to do well like Google. Qualcomm, that's going to tell us more about semiconductor. These guys are not tied to the data center like other semiconductor companies, but we'll see how their business is doing. Caterpillar, big industrial. We got an energy company in Total. ADP will tell us about their services for payroll. And you've got a lot of companies in here. Train is an industrial. Canadian Pacific Railway, Equinor, and FYI, oil prices have been moving up nicely. So if they keep moving up, oil companies are going to keep doing well. Thursday, Apple, Amazon, huge. Apple's dealing with, as these tariffs create tension between the US and China, Apple's very dependent on China for manufacturing, for their supply chain, and as a market to sell into. So they're kind of in the danger zone of if these tariffs are going to hurt the relationship between U.S. and China, maybe Apple is one of the companies that really comes out losing. We'll see. And we'll see what they announce. We'll see if they can start growing their business. They've been flat for a while. Amazon, huge. And what they announce on their e-commerce business is really going to, I think, swing the market one way or the other. And what they say about their cloud business as well. And Amazon is a diversified business. They have terrific businesses in a number of areas. So it'll be very important to see their earnings. Eli Lilly is the biggest healthcare company. We'll see if they're continuing to have a lot of momentum around the weight loss drugs. MasterCard, similar to Visa. Lind, Amgen, which is a healthcare company. Stryker is a healthcare company. MicroStrategy, a Bitcoin currency. Hodler. So interesting company that has really increased their market cap. Pretty much, I think it's quadrupled in the last 2 years. So MicroStrategy's gotten it done for its stockholders. CVS Health, I'm going to really monitor that one. I'm a stockholder. And then Airbnb, that's a stock that I own. I'm really concerned about travel. I think the airlines have expressed a concern that travelers are not like now. I read an article just today that domestic travel is down. First, international travel was beginning to go down. Now domestic travel. And if travel is down, I expect that Booking and Airbnb are going to have less revenues, or I would say their revenue growth is slowing. So we'll see what they have to say. Friday, big oil Friday. Exxon, Chevron, Shell, and then a consumer staple in Unilever, Eaton, Cigna, healthcare company. So we have a lot of earnings. It's going to be really busy this week. And I think these earnings are going to be the most impactful information stream that we're going to have on stock prices. If we have positive news coming out of companies, I think we're going to see the stock market flourish. And right now we have the Asian markets are beginning to open. So let me take a look at Asia. I know Japan's open. Let's see here. Oh, that website's not giving me what I need. So let me take a look at here. So it looks like the Nikkei is up 1.9%. And I don't think China's open just yet. It'll open up in an hour or two. So that looks interesting. Actually, the Nikkei is only up 0.72. So that's still up. That's a sign of maybe, hopefully, that Asia has a positive day, and then that goes over to Europe, and hopefully it comes over to the US. Josh Blinzer, wild week ahead. Patience pays off. I'm playing smaller on day trade attempts. GLTA. Cool, man. Good luck. I agree that, patience right now, and I think where I'm exhibiting patience is, I'm not buying a lot of different stocks. I'm holding the companies that I really believe in. I'm buying into just 3 stocks, and I'm hoarding my cash. Cash is, there because I think we could see another, downward selling rally, or I guess um, sell off. And if that sell off happens, I want cash so I can buy in higher units, higher stock units of the stocks that I really like. So that's why I'm keeping the cash around, and I'm being paid 4% on it. So that's not bad. All right. So Anthony, I see UPS. Definitely I can look at UPS. All right. So let's take a look at UPS, and then we'll look at Amazon and a couple of other companies. So UPS is a delivery company. It's an industrial. It's down 33%. And a big part of what's ailing UPS and even FedEx is Amazon's become so big that they're taking away the delivery market share away from UPS and FedEx. And I think that's what's hurting the growth rate of UPS. You look at the company, they're not growing in the trailing 12 months. They barely grew last quarter. They had a decent growth rate in Q3, but there's a lot of red on the screen here. You have 1, 2, 3, 4, 5, 6 consecutive quarters of negative growth. So the company went from 100 billion in revenues down to 90 billion. That's a pretty good haircut. And I think that's what is ailing the company is you have a business that fell in revenue size and now is kind of going flatline, like just going sideways. I think that's the number one issue. Where are they going to grow? How are they going to grow? And the challenges they have is we're in a slow economy. We may not be in recession, but I think we're in a slower economy. So I think that's going to be tough. The business is over the 1 year, it's down 33%. Over the 5 year, not a good picture. And you see really the downward trend started in 21. It has just been moving down. And if you look at in 2021, you were above $200 a share. Now you're under $100 a share. Not a pretty picture for investors. And this is a business that's been around for a long time. Very recognized, I think trustworthy company. None of that has changed. It's just the business isn't very desirable. It's not growing. Let's take a look at other fundamentals. The PE is really low. It's low because stock price is down. It's a value stock, but it could be a value trap. Analysts like it, but it's 32% discounted. Now, when I look at a company, I measure the value of that company principally on the free cash flows it produces and trying to discount those cash flows to today's value and being able to say, hey, am I buying that business at a discount? If I measure it based on cash flows. And let me take a look at those cash flows and see what I could tell you just kind of high level about this company. So they're not growing. So they have $6.2 billion of free cash flow. If you're not growing, and I just want to see, high level, are they discounted or being priced at a premium? I would multiply that times 10. I multiply times 10 when there's no growth. And that would get me to about $62 billion. And I could also say, but it's a really good company. So maybe I multiply times 15. That would get me to about $93 billion. Then I decrement debt. I take away debt because that would be part of my process. And they have about $19 billion of debt. So the best case scenario is they're 94 billion minus 19. That gets me down to 75 billion or so of value. That's the best case. And they're at 82.98. So this is an alien business that has been on a really nasty trend, just long term, been going down in value. The dividend is going up, but these are the types of stocks that, I respect that people like dividends because they like the income, but I would just caution people that sometimes dividends get you into a stock that takes away or erodes your wealth. It is going to cost you more than it's worth, because I don't think anybody would sign up for a 6% dividend when they're losing 33% of the value of the stock price. That's just a money losing situation. And that's what I caution you is, study a company and decide what is the value of the business. Don't look at dividends. That doesn't tell you the value of the company. That just tells you what the company is willing to provide as a dividend. That in a lot of ways is marketing. It doesn't increase the value of UPS. It doesn't decrease it either. It could make it riskier. If they have a lot of debt and you have a dividend, you're just making the likelihood of that business going bankrupt a little higher, making it riskier. So I would encourage you, don't use dividends for the valuation. So this stock is overpriced. It's overpriced by, I would say, about 20% to 25% based on their free cash flows. It wouldn't be a stock that I'd invest in. Doesn't have positive momentum. The balance sheet's fine. Analysts will look at earnings per share, and the earnings per share may be looking good, but you have a business that's declining in sales, and they're supposed to decline in sales this year. Again, we're kind of headed into a recession. That isn't good for UPS. If people are going to buy less goods, it's bad for UPS. And Amazon keeps getting bigger and bigger and bigger and managing their full supply chain from, every aspect. As Amazon does more, they don't need UPS for much. So UPS is a sell for me. It's just not a stock I would want to buy. Now, when I was a youngster, I worked a winter at UPS. They would hire seasonal workers to work the Christmas season. I was in school and I went to work for UPS. And I gained a lot of respect for that company. It was very militant in a good way, very teamwork managed. The management teams were really, really good. My direct manager, man, he was like a football coach. He would pump us up, and we were these youngsters that would just go unload trucks. I didn't have to go to the gym. When I worked at UPS, I would unload trucks. I'd be full sweat. Like my t-shirt would just be drenched in sweat. And I loved it. And I got done with my assignment. They offered me a more permanent role, but I had to focus on my studies, and I said no. But I gained a tremendous amount of respect because I think people that worked at UPS really enjoyed working at UPS. They really felt proud of being a part of that company. So there is no loss in respect for UPS. But I invest in companies to make money. and I look at the fundamentals and I look at the cash. There's lots of businesses that I'm a fan of that I don't invest in. I don't think they're a good investment, and that's UPS. So Anthony, okay, we agree on that one. And logistics right now, man, they're in a tough spot. I mean, we looked at Union Pacific this past week. They announced their earnings, and Union Pacific, I think, sold off on their earnings. So they announced on the 24th, and the 24th was that Thursday, yeah, and then they sold off. Looking at the 5-day, they're down a little bit over the 5-day. And I showed early in the stream that the market went up like more than 9% on the NASDAQ. So during a real positive week, Union Pacific was down. That's a logistics company. It's not a really good space right now. Now, as we work our way through these tariffs, and let's imagine a situation where tariffs are pretty much solved. Okay, we're no longer arguing with other companies and causing potentially disruptions to supply chains, and the economy's looking good. Maybe 6 months from now, 12 or 18 months from now, we kind of see that we're in that situation. Coming back and looking at United Parcel Service, FedEx, Union Pacific would be a really good idea, because that would be the cycle moving from it's bad to own these logistics companies to it's good to own them, and it's good to buy them early before everybody else. And then when everybody else catches on, you see your stock price go up. So I would say UPS is worth keeping on the watch list and waiting for the economy to look brighter, to look better, and for us to get through these tariffs. So that'll be the final thoughts on UPS. Brandon, good to see you. And you want to look at TRMD. So TRMD. Torm PLC, a shipping company, owns and operates a fleet of product tankers in the United Kingdom. It operates two segments, tanker and marine engineering. The tanker segment transports refined oil products such as gasoline, jet fuel, kerosene, gas oil, and as well as dirty petroleum products, including fuel oil. Okay. So these guys are moving oil and oil products around. Oil prices have been going up. So I imagine these guys are catching a rally here. The last 5 days up 6%. So oil prices have been moving up. And if oil prices are moving up, that means there's demand. And if you have demand, especially like in areas where they just don't have any oil, they have to import everything. That could get really interesting for Torm. These guys have a humongous dividend. And I'm going to look at their dividend history in a bit. So in the 1 month, it's down 10%. The 1 year, it's down 50%. 5 year, look at that chart. So coming out of COVID, oil, especially during COVID, demand on oil was terrible. And then it took a while, but then demand for oil in 2022 really went up. Oil prices really went up in 2022. So if we have increasing oil prices, this stock can really begin to work from an appreciation standpoint. Let me take a look at what kind of cash flow they produce. We'll see what kind of dividend they can afford. I imagine people want to buy into this stock because they like that dividend. So free cash flow has been good. So for 22, 23, 24, looks like very good cash flow. The cash flow per share in the most recent closed year is $2.54. Their dividend is $5.09. I doubt they're going to be able to match that dividend again. Their payout ratio would be like 200 and some odd percent. That's a bad idea. You don't want to put the longevity of the business, at risk just to pay a darn dividend. They have 272 million of cash, a little bit of debt, less than $1 billion of debt overall. So debt's okay. Now, I would argue, why'd you pay such a big dividend? Pay off your debt. Make your balance sheet really, really strong, especially in a business like theirs that you have periods of time when they just flourish and periods of time when they just really, struggle because they're not, there's no demand for shipping of the product they carry. So let's take a look at the dividends. So they paid a dividend of 60 cents a share, March 20th, 2025. That is affordable. As mentioned, they have like $2.50 of free cash flow. So that looks affordable. And before that, they had 4 dividends in the 2024 year. And that's why they're showing up as a 30% payer. And they did pay a lot of dividends. Okay. I don't think that's going to repeat itself. You see that they paid 60 cents on March 6th. And the year prior, they paid $1.35. So less than half of what they paid in the previous year. It's still going to be a substantial dividend rate. Let's say we just take the 60 cents times 4. That would get us to $2.40 a share. And we have a stock price of $16.54. That's more than 10%. That's about 16. That's about 14% dividend. That's fabulous. I think they can lower it down. I mean, look at their stock price, right? I think they should lower their dividend. I say you hunker down, focus on being the best operated company you can be, and get this stock price to work. Because no sense in chasing this dividend at 30%, but you lost 50. Easy math. This is a loser. But if they can start to get this stock price to really rally long term, and maybe we see this 5-day run just continue on, and next thing you know, for this year, they're up 5 or 10%, and they paid an 8% dividend. Hey, a combined 15 to 18% rate of return on this would be good. What would be better is if they really rallied, maybe you're up 20% on the stock price and you got paid an 8% dividend. That'd be even better. So this is an interesting stock, but I just see too many things that need to be need to take shape, need to materialize. One, okay, how's your revenue going to do? Let's look at the quarterly. See, this quarter was really down. This most recent quarter, down 21%. That was really, really contracting month or quarter. And when we look at, and that compare wasn't that difficult, right? But the Q1 compare is going to be tough. So I'd want to see some growth. I'd want to see some green on the screen. Looks like Q4 tends to be a tough quarter. But I'd like to see some green on the screen. And I'd like to see oil prices have a long-term appreciation. Oil over the 5-year. Okay, so here's the 5-year. And really over the last, 2.5 years, oil is really traded in the 60s, low 70s. If we get a rate of appreciation on oil prices like we saw in 2022, then Storm and oil companies and the whole oil complex will become much more valuable, and you'll see it really, really flourish. But we're not seeing that. You actually see the opposite. We've seen kind of a trending down line here. So I would wait. I personally would not buy into TORM. I think that there's potential that this is just going to be a bad story for a while, like a tough, depreciating stock. But if things begin to turn, if we begin to see oil prices have a long-term appreciation curve, like see even year to date, we were in like mid 70s and now we're down to low 60s. We can get that back up to $70 a barrel, excuse me. I think a lot of things change. If we see a rally up to 75, boy, you're going to see a lot of things change. That's a lot of ifing, right? And we got to see the commodity market. We need to see more demand. And if we see more demand, okay, great. That's going to really make the oil complex more valuable. So TORM is not looking good to me. What do analysts are going to, there's only one analyst. So there's one analyst and I'll give you my opinion and we'll read this opinion here. You're seeing a big contraction in revenue. That scares me away. I'm like, no, thank you. I don't want a big contraction in revenue. So that is TORM. Now, the other thing I would comment on is you have a market where you have other stocks that have been sold off quite aggressively. And if you follow those stocks, you're like, man, there's a pretty good opportunity across the board. Like in healthcare, there's good opportunities. In oil companies, like TORM, I'm not in love with because I don't think they have like a big, like they're not that valuable. They're shipping the product, but what is more valuable is like Occidental. They own the rights to extract oil from certain parts of the world, and they extract it and put it to market. If we see oil prices go to $75 a share, Oxy will go up in 50% in value. So I'd rather own, which I do, I own Oxy instead of TORM. I feel that there's a better risk reward situation there. I think if oil prices hit $75 a share, I'll make more money owning Oxy than I will TORM. Oxy, I don't think pays a dividend. And that's the stock that I'd rather own if I'm going to take a high risk on this particular industry. And let me read your comments, Brandon. So I saw Howard Marks owned a lot, but I didn't see the peel over shipping stocks. Yeah, you're welcome. Some of these super investors, they own certain stocks, and I think they believe they see something in those stocks, and there's always something good to learn, right? But I've owned shipping stocks. I've done well with Zim, buying in and getting out, buying in and getting out. And before that, I owned a stock that is my favorite shipping company because it made me the most money. And that's Pangaea Logistics. What's been going on with these guys? I haven't seen them in a while. They're down 21%. But let's look at the 5-year. I bought them here at $2 a share. And it can continue to go up. And I think I exited around here. So I had a tiny company. I bought back here. They were like much smaller than this. And I took these guys for a ride, and they took me for a ride. And what I liked about Pangaea is they have a unique proposition in shipping. They own ships that take all this like dry bulk, gravel, a lot of materials that you would do construction with, infrastructure, and they get them over these ports. They also can get to these really difficult areas like up in Canada and that like areas of the ocean that ice up. These guys have a lot of expertise of getting up there early and moving product. So I thought these guys were worth the risk, and I made money here. So I've made money with Zim. I made money with a Pangaea. So I'm not opposed to making money on shipping. I'm just looking at it going, I don't see how we can make money with shipping companies right now. But at like same thing with UPS, that and here's an example of what they do. They can break through ice, which is really neat. Well, it gives them a competitive advantage, right? If somebody wants to get to and from the areas that have ice on them, this is who you call. Well, that specialization creates a competitive advantage. And I like that about them. So back to UPS and ocean logistics and railroad companies. Right now is not the right time for me to buy into them a whole lot, but keeping up with it every 3 months is, seeing where are we with the economy. Once we see that, hey, we've hit the worst part of the economy, we're going to start to grow. Now let's come back to logistics companies. Let's buy early. Let's buy early so we can buy, when we're buying here, and then we can see the market buy into the stock and reward us. We'll take the ride up. Right now, I don't think we would take the ride up. We would be riding the ride down. I don't want to ride the ride down. I want to ride the ride up. So let's keep an eye on them. And doing these streams, we can do it together. Let's keep coming back. And next month, let's look at logistics. And the month after that, let's look at logistics. And when it starts to look good, then we'll get in early and then we can make some money. All right. Good one. Thank you. David Trizil. Very good to see you, sir. Thanks for joining. It might be your first time on a stream, at least providing a comment. Appreciate you attending. And Anthony, what kind of work did you do in the oil industry? Yeah. So I graduated in accounting, and I live in Southern California. And my first job out of college was with an oil company by the name of Unocal. Unocal was acquired by Chevron. And I got a couple of the jobs that I had within the oil industry. The first one was I did accounting for the natural gas fertilizer business. It happened to be the most profitable part of Unocal. Natural gas was when you turned it into fertilizers and chemicals, it just had the best margin for Unocal. And then from there, I took on an assignment with the petroleum products division. And there we sold, in the oil business, you have exploration, which they refer to as upstream. You're exploring, finding it. Then you have mid-market, where you're refining it. You're doing something with it. And you have downstream, which is you turned it into a usable product, gasoline, diesel, lubricants. And so I moved from kind of a midstream operation that was a chemical company over to a downstream operation, which was we were actually accounting for the gasoline stations and so forth. And a really professional company. And they gave me some really good experiences, specifically around software of all things, because it was an old company that needed a lot of modernization. And we implemented new software in the chemicals division. And then we implemented software in the petroleum products division. And although I went to work as an accountant and I enjoyed accounting, really like accounting, those software experiences, were really interesting and fun. So I moved away from the oil industry. I went to the pharmaceutical industry, where I was a controller and again implemented software systems there. And then I decided just to go into the software industry after that. And I've been a software industry professional since then, selling big enterprise software to companies to help them modernize. So that's the history with me in oil. And I appreciate the job. Unocal, Chevron, great experience. And I appreciate it. All right, so that's Unocal. That's the oil industry. All right, so let's take a look at Amazon. That one came up a little earlier. And Amazon's going to announce on the 1st. That's Thursday. They think they did well last week. Yeah, 13%. That's very well. So good deal. 13%. And year to date, they have been correcting. This is a stock that, it's a buy. When you see this company have this kind of pullback, This is one of the most important businesses in the world, and they are huge. $638 billion, the highest revenue company in the United States. They took over the title from Walmart, and they're growing at 11%. 11% on 638 billion is 60, almost $70 billion of growth, revenue growth per year. 70 billion. And if you look at big companies like Uber, Spotify, Palantir, those businesses are not $70 billion in revenue. And Amazon's growing by $70 billion in revenue per year. That's just mind-boggling. Not only that, their businesses are exceptional. The e-commerce business, nobody will argue that's the best e-commerce player in the world. Nobody will argue. Their cloud business, nobody's going to argue. That's the biggest and the best. They were the first ones to the market. They captured that market. They're doing great with it. Let's move on to their streaming business. It's doing really well. They're running really well. Not only that, they're starting a robotaxi business. They have the Zoox robotaxi business. It's like, Amazon, is there something you don't do? And everything they do well. So it's just a really, really good company. I have the stock. I think it's fairly priced. I'm going to take a look at that in a minute. But it's one of those businesses where, as you construct your portfolio, it's really what you intend on doing and how long you're going to do it for with your portfolio. If you're, for example, hey, I need the money in a year. I need the money in a year to buy my dream home, or I'm going to buy a piece of land and I'm going to build my dream home, or I'm going to start a business in 1 year. I'm going to start a business on my own, or maybe a partner and I are going to start a business. We're going to buy a business. I need this capital back in 1 year. Well, your portfolio would probably have a lot of short-term bonds and money market accounts. Very low risk. Let's put a period on that and let's put a different scenario together. Let's say you're at another extreme where you're like, hey, I'm a young person. I'm 25 years old. I'm in the middle and just kind of beginning my career. I've got a job. I'm making a decent amount of money, and I'm putting away, 20% of my income. And I would really want to focus on saving money, earning money and saving it, and having my money work. I'd like the highest rate of return, and I'm willing to deal with volatility. We've experienced volatility for the last 2 months. That is the entry fee for high returns. High returns are what I would encourage a 25-year-old to go after. And I would encourage them to get tough around, being able to stomach down markets, because what you want is you want to see your capital over 5 years double. This is the NASDAQ, the whole index. If you put 25,000 in, 5 years later, that same capital is worth 50. That's what I want for a 25-year-old. And to do that, you need to find a combination of companies that are going to get you there. And Amazon is such an important company, growing at 11%. And it's been priced. What I found to be so surprising is that Amazon wasn't priced higher during this era, and then it did really start to rally. Over the last 2.5 years, investors have more than doubled their money. So finding Amazon, buying it at a good price, and then holding it, I think is going to help an investor double their money every 5 years or sooner. Amazon's kind of a good anchor stock, like good to have it. It's going to be there. It's going to be worth a lot more in 5 years, a lot more in 10 years. It's just pretty much as solid as you can find in a business. And with this pullback, it's given investors an opportunity. And this pullback gave investors an opportunity. So this is a stock that I have a buy on, although it's not incredibly discounted. This one does not fall into the Howard Marks. Hey, it's more important that I get the right price versus I bought the right stock. I would say that this is more of like the Warren Buffett kind of, I want to buy great businesses, and I'd rather pay a reasonable price for a great business versus getting a great price on an okay business. I phrased that completely wrong, but you get what I'm saying. That's basically what he meant. So Amazon is actually priced 20% above its intrinsic value. But I still feel the same way about Amazon. It's one of those super valuable companies that is going to keep appreciating. And I own Amazon. It's had a nice week or two. Last time I looked at it, it was closer to intrinsic value. It went up 11.5% in the 5-day. So I think that's what, from the last time to now, it's gained some value, which is good. So that's where Amazon is. Of the big major caps, I think the best pricing that I see out there is on Meta. Meta right now has a lot of things going for it. The one thing it doesn't have going for it is the government wants to break it up potentially. Well, that's going to be a problem potentially, but those are all maybes. But for sure, this thing is, it's discounted. It's beginning to do better. This is also one of the really desirable businesses. And the worst case scenario on a Meta breakup is a Meta stockholder would be both an Instagram shareholder and a Meta shareholder, which I guess would be Facebook and WhatsApp. Well, you still have, two great businesses. Instagram's a phenomenal business. And the Meta AI business is looking great. So AI becomes a really well monetized business. Meta has a great business for that. So I really like Meta. I like Amazon. I like Google. Those are the ones that I like of the big massive caps. And so those are my comments there. Listening to the Amazon earnings and reading about them is really important. That's must-do work for us this week. All right, so let me catch up. Okay, so a lot of people don't like dividend stocks. Yeah, so let's so the way that I treat dividends is I'm kind of it's an added benefit. Okay. I do think that having a mechanism of creating a revenue stream is a positive of a income stream. It's just a positive. For example, like if you look at Pfizer, it's creating a revenue stream. That's a positive, but it's not the base of evaluation like Meta, right? Nowhere in here am I valuing the dividend. Now, if you're in a Roth or even a 401k, and you're not going to pay ordinary ordinary income tax on dividends, because that plan is going to require you to use that dividend to buy into the stock that you're holding. So you are correct. There's no tax event in an account like that. So I got that. So I would say that having an income from the dividend is a positive, but it's just like a feature of the stock. Where I see potentially dividend stocks being a problem is some investors view it as, no, that's the way that I will find a good stock. I will go find a good dividend paying stock, and I'll measure that by saying, oh, do they pay 5% or they pay 6% or they pay 8%? Well, I think we saw a few examples where who cares if they paid 30% dividend? You lost 50% of your stock value. So just don't get into this situation. That's what I'm mainly saying. But if you found a situation, let me point to one of the stocks that I think is pretty good for me to start buying into. So Dow is a material stock, right? And they've been doing terribly, down 47%. The stock price is really sold off. This one is a Howard Marks special. It's not what stock I bought, it's what price I got. So over the 5 years, this thing's down 9%. But look at this appreciation run that they had a couple years ago. Now, Dow is a company that I know have known of for a long time. It's a materials company. And coming out of COVID, these guys were up 100%. What's there not to like? But since then, not so pretty. Well, this sell-off, right? Is it really 57% less valuable? That's where the questions begin for me. And I think the trail to opportunity begins. So this has been really sold off. And when I evaluate Dow, I think it's a buy. I think it's discounted. I think that the best is ahead of Dow, and I think I'm getting in a little early. And they have a dividend yield of 9%. So the dividend is an added positive feature. I like it. I want it. But I went through the decision of buying Dow by using valuation. What do I think is going to happen? I think Dow is going to begin to operate better as a business. And then the market's going to pay attention and start buying the stock. It's also part of the number one performing sector right now, materials. It's not by accident that I got to Dow. I look at data. The number one performing sector in 2025, materials. Because materials are needed, commodity prices are going up, you have a tariff war. Well, I'm going to charge you more for this material and that material. Well, material companies are loving it. They're like, yeah, hey guys, argue, bid up the price. Thank you very much. So knowing this, I've been buying into 3 materials companies, and one of them is Dow. So back to your point of, is a dividend a bad thing or a good thing? It's a good thing. It's a positive feature. I don't have anything against dividends. I actually think it's positive, but it's not part of my decision. Once I arrive to like, hey, I think Dow is discounted, great. And they pay a dividend. That's even better. Excellent. So that's how I would express it. And you are correct that, if you have dividends and you have these stocks, again, in a 401k or an IRA, you don't pay tax. It's not a taxable event, because that taxable event is going to happen when you draw the money. And then the government will treat all the money you're drawing as your ordinary income. Now, I'm not a tax professional, but I was educated in tax, and I do my taxes every year. So I have maybe above average knowledge of tax and know this particular area, but I'm not giving you any tax advice. Don't take anything what I say as tax advice. Don't take it anything that I say as financial advice either, but take it as just my point of view as I look at these companies, giving you how I see things and how I invest. So good stuff. Good question. And Shani Loca 369, Google. I covered Google. Good video on my channel. Go to my channel, look at videos. I think I produced it on Thursday night, so it's pretty recent. Anthony, Shopify. So let's take a look at Shopify. So Shopify is an incredible success story. This is a commerce software company up in Canada. It might be the most valuable Canadian company. At least at one point it was. They were flourishing. They came out of COVID and just they were worth $169 per share. So their market cap was higher. So they're doing great. Revenue's $8.88 billion. So investors are paying, wow, it's an expensive stock, right? Because you're paying, what is that? About 16 times revenue. So you pay, it's an expensive stock. PE 62, expensive stock. Okay. Now they better be growing. They're growing. Okay. The growth is there, 25.78. That's very good growth. And the last quarter is even better than that. So that looks good. So their growth is excellent. The free cash flow is good. See how they've grown cash flow? That's a very good sign. That's a sign of a valuable business. 1.6 billion in free cash flow over the trailing 12 months. Their gross margins are 50%. They're kind of a cloud company in that they provide this e-commerce is kind of a service. Businesses can go set up Shopify and set up online stores. And I think their business is terrific. But their margins are not stupendous like NVIDIA or a pharma company or a Meta. They're not that high. So 1.6 billion, growing at 25%. I'm going to multiply that times 30 and then take away any debt they have. And they have no debt. They have $5.5 billion of cash, $1.13 billion of debt. So the cash balance is about about $4.4 billion. So I'm actually adding to that. So 30 times 1.6 is going to be 48. And then I add 4, I'm going to call it 5. So we're up to $53 billion of market cap value. They're at 125. It's hard to get to that number. That cash flow is not very high. So $125 billion in market cap. Let me show you an example. So I treat Shopify as a software company because the magic to Shopify is they're a really good e-commerce company. They write code and they provide their software as a service. Businesses can operate e-commerce. I think they have a rightful place in the industry. And if I look at, let's take a look at CRM, and actually Salesforce is one of their competitors. Now that's not a perfect match because they're not growing fast enough. Let's look at AppLovin. So AppLovin, $93 billion in market cap, Shopify, 125. So they're in the neighborhood. Okay. This one's $4.7 billion in revenue. So this one is expensive too. It's about 20 times revenue. PE is about the same level as Shopify, but the forward PE is lower. Free cash flow. This is where this company becomes more valuable. This is $2.1 billion of market cap of free cash flow trailing 12 months. Shopify was 1.6. The intrinsic value of a company is the ability for that company to produce free cash flows that are put on the balance sheet, returned to shareholders in the form of the cash on the balance sheet, because that is inherently value, dividends, stock buybacks, or they continue to deploy that capital to make the enterprise more and more valuable. So AppLovin has a lower market cap by like $30 billion, and it produces $500 million more in free cash flow and is growing their cash flow quite in a linear fashion, better than Shopify. So AppLovin's growing 43%. So you could buy this stock for less money if you think about the market cap of these two companies. And this one stands to be a better performer than Shopify. That is $125 billion market cap, producing $1.6 billion of free cash flow. And just to take a peek at the balance sheet, these guys are in debt a little bit by about $3 billion. I don't think that'll make a difference. I think AppLovin is a better buy. And to go one step further, if we're willing to take a higher risk and go with a smaller company, a company that has a market cap below $1 billion, software company, doing something that's very similar to AppLovin, you can get this company for about 3.5 times revenue. The forward PE looks okay. Current PE looks kind of high. This is less than 1 billion. And these guys are already producing free cash flow of $49.27 million. This is a small software company that does omni-channel marketing automation, similar to AppLovin. So I'm a fan of Shopify, but I just think that so many investors buy into the stock because they know of the company. And when you look at the valuation, it just does not price at a discount. I think that AppLovin may be at a discount, depends on how their stock's been doing. I track AppLovin. I think I could give you a valuation on AppLovin and DSP. I don't know if I have Shopify. I don't think I have Shopify. No. Shopify, every time I price it, it's so much in the red that I just don't want to spend a lot of time there. And that is the wrong one. Yeah, so AppLovin's discounted by 13% right now, even though it's been appreciating nicely. And then DSP has a better discount at 32%. I'm buying into DSP. I'm taking the higher chance with a greater rate of return. So when you look at a Shopify, what's great about the market right now is there's discounts in many places. So when you look at a software company, look at a couple peer companies or something that's similar and buy the best deal, right? If let's say you're a runner, right? I'm sure there's a lot of runners out there and you're like, okay, I need a good running shoe, but I don't want to break the bank. So you go into the, sporting goods store or running shop. You're like, what do you got for runners like me? And they go, here's 3 shoes. This one's $300. It's got everything you need. This one's $200. It's got everything you need. The difference being that maybe it's a color that you didn't think about buying. You have this one at $100. It's got everything you need. And you're like, well, the coolest one is at $300. But if I could buy 3 pair of the least expensive one, it has everything I need. And I'm going to beat the shoe up anyway. I'm going to be running on it every day. So stocks are a little bit like that, is you can buy discounted stocks that really flourish. And they're still really good businesses. All 3 businesses that I showed that are software based, these are terrific businesses. And AppLovin and Viant are less known because who really knows, like, the software that tells marketers you should be advertising during the episode of whatever show on Amazon Prime. That's where you need to advertise, because that's where your target market likes to watch that show. That's what those software programs do. That's harder for investors to get their head around. Shopify, very easy. hey, I know e-commerce and Shopify is one of the big players. Yeah, I agree with you, but a lot of people are in the stock and the stock's expensive. So that's how I think about things. And that's how Howard Marks would say, that's how you got to think. You got to think, I need to get the best price possible. It's not about owning the best stock. It's about getting the best price. All right. Software. So Anthony, I personally love the product. I agree with you. A lot of people like Shopify. I like Shopify. I think Shopify is a cool company. I think Netflix is a really super cool company. I've made money on Netflix, and I think Netflix is priced too high. That's another example. So it's not about like, we can be fans of businesses all day long. Another example is like the entertainment business, right? Like I think Paramount just got sold. They got taken private, and the whole valuation of Paramount was 10 billion. Only 10 billion. But Meta's worth $1.5 trillion. Very big difference in value. Now, Paramount, I'm very familiar with Paramount. They had great movies. They have CBS, which is a television, channel. They broadcast NFL football on it. I'm very familiar with the Paramount business. I would have thought the business is worth more because it's just so recognized, but it's not. Inherently, it doesn't have value. It doesn't have the value that a Meta does, or an Amazon, or Google, and others. So that's how it goes. Some of these really, like Apple, I think is a little bit of that. Everybody knows Apple, and that's why the stock is so darn popular. Everybody can get their head around, hey, I have an iPhone. It's a good business because I like my iPhone. Well, maybe it is, but maybe a lot of people feel the way you do, and they don't invest based on intrinsic value. They just invest on popularity. All right. So yeah, I think, the software space, and something we saw this past week that was good. This is the 1 week heat map. Look at the software space here. CRM, Salesforce up 13, ServiceNow up 25, Adobe up 7, Workday 11%. This is Cadence 15. Microsoft was up 9, Palantir 24, CrowdStrike 17. Software really did well this past week. And I think software over the last year, I'm going to change this to the 1 year heat map. Well, Microsoft's down 4% over the 1 year. CRM's down 3%. Intuit's down, right? So you have some red here. Adobe's down 22.9%. And where I'm leading is the software space has not kept up with the semiconductor space. This was taking a lot of dollars. Well, now those dollars are coming back because software has been known to be a very resilient, dependable, high value industry that has high margins and high free cash flow. So this is, I think, a really fertile place to find good value. So if you dig into software, I think you're going to like what you find. And it's all about, getting a good price. So if we look at the 1 year, or even see if this thing will give us the 3 year. See how NVIDIA is taking a lot of investment. So as Broadcom. ServiceNow did really well. CRM did well. This chart is taking too much into account, I guess. So I think the software space, I think you're going to find a lot of good things right now. And that's what's good about having a market where we had a really nice, solid correction. We have stocks were sold off, some more than others. It kind of cleans up a lot of this euphoria pricing. So good luck there. Is it Elon Rothenstein? ASML. I did a video on ASML. It's on my channel. Please take a look. thanks for attending. And yeah, thanks, Anthony. All right, guys. So let's let's call it a night. Wanted to stream as we head into the week, just kind of get my head around the market. Let's see if Asia's telling us anything we want to know. So Japan is up a little bit. Shanghai's down a tiny bit. It seems like the tariff talks, I think, are happening between the US and China. It may be a slow process. Hopefully it doesn't have a bunch of like noise, like, you know, some headlines of, oh, we're going to raise our tariffs on China and make it harder for us to do business together. I hope not. I hope none of that happens. And all that could do is just create more tension and noise and uncertainty. So hopefully it doesn't happen. Hopefully they just figure out what's a win-win, what's going to be a good win-win for the US and a good win for China. And I'll be streaming probably every day, and I'll be having the member calls, one on Tuesday morning and one on Wednesday evening. So we talk about the market. And members, you know where to get a hold of me on Discord, on email, over comments. Let me know if there's anything you need. And really appreciate your support. If you're not a member, please consider being a member of the channel. I'd really appreciate that. Comes with a lot of good perks, and you can take a look at the details of the video for that information. So everybody have a good night. Fingers crossed that next week is a little bit like last week, or a lot like last week, frankly. I would totally be on board with a 9% rate of return or appreciation on the NASDAQ. So have a good night, everyone. Thanks for tuning in.